Hi, welcome to Easy Learning Economics. In the previous lecture, we constructed the consumption function, saving function, and in this lecture, we shall determine the equilibrium level of income, equilibrium level of consumption, and savings at that equilibrium level of income using consumption function, and then finally decide is the government is running budget deficit or surplus. This data is given. This is the consumption function, that is 200 plus 0.75y. As we know that 200 here is the autonomous consumption, which is independent of the level of income, and whereas 0.75 is the marginal propensity to consume and dy is disposable income, and the investment is $100 million and government expenditure is $200 million, and tax rate that government charges, that is 20%. Using this data, we have to determine that what is the equilibrium level of income, consumption, saving, and is the government running budget deficit or surplus. We learned in the lecture two-sector economy that saving is equal to investment. If you want to learn more, you can watch my lecture. Under three-sector economy, the output is equals to consumption plus government expenditure plus investment. In the three-sector economy, that household, firm, and government interact with each other. Here we substitute this consumption function for C. Instead of C, now we are using given consumption function 200 plus 0.75y. So consumption is equals to 200 plus 0.75y. This is the y minus 0.2, because the income is equals to y and 0.2 is the tax rate which the government charges. So it would be the equals to personal income minus tax rate is equals to disposable income. So dy is disposable income. So the government expenditure is 200. So we are taking this figure 200 here, and investment, that is $100 million, that we also incorporate here the $100 million. So using this, after solving it, the income would be equals to $1,250 million. We are now cross-checking by finding investment. If the income is $1,250 million, so the investment must be equal to $100 million. As we know that the output or GDP is equals to consumption plus government expenditure plus investment. You can see here that when the national income or GDP is $1,250 million, the government make expenditure, that is $950 million. So we shall prove it that how $950 million the consumption at the given level of $1,250 million. At this income level of 1,250, the investment has been proved, that is $100 million. So now we are going to see whether at this income and investment level the consumption is $950 million or not. This is the equilibrium level of income. So now we are going to search for the level of consumption. So this is the data which we already discussed, that consumption is equals to 200 plus 0.75y. So the disposable income is 1 minus 0.2. If income is 1 and the 0.2, that is the tax rate which the government charges, disposable income would be equals to income minus tax rate. This is the income and this is the consumption function, and 0.8 is the marginal propensity to consume. You can see here this is the consumption of $950 million when the income is $1,250, and also we proved the investment is $100 million. So what would be the government taxable revenue at this given level of income? The government tax revenue would be equals to total income into tax rate. Total income is $1,250 and government charges 20% tax rate, that would be equals to $250. It means $250 million the government collects the revenue through the tax. The government collects tax revenue of $250 million and makes an expenditure of $200 million, and public saving is $50 million. It means the government is running budget surplus in the economy by $50 million. What would be the national savings at the equilibrium level of income? Saving function is equals to minus CA plus 1 minus beta Y. Minus CA is this savings when the income is zero, that the consumer has to borrow from someone else. 1 minus beta is equals to marginal propensity to save. Beta is marginal propensity to consume. This is the autonomous consumption. When the income is zero, the consumer has to spend on the purchase of food, shelter, clothes. So this is the dis savings. When the income is zero, the consumer has to borrow or to use his wealth in order to meet his basic needs. Here beta is slope, or that the marginal propensity to consume, whereas 1 minus beta is equals to marginal propensity to save. Remember that beta is marginal propensity to consume and 1 minus beta is marginal propensity to save, and Y is income. Autonomous consumption is 200. 1 minus beta, the marginal propensity to consume is 0.8, and that income is $1,250 million. So the saving would be equals to $50 million. So it is proved that the national savings at the equilibrium level of income is now $50 million, and the government is running budget surplus. I hope this would be helpful for you. If you have any queries or suggestions, let me know in comment box. Thanks for watching.